Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Want to do a quick video because there's some interesting stuff happening. The stock market was down last week, down quite a bit pre-market. Dow down almost 900 points, the S&P down 180 points, Nasdaq down almost 900 points. Tech's being hit pretty hard, but across the board, the market's being impacted. A couple of things driving it. There's the yen carry trade where people were essentially using the low interest rates in Japan and the fact that their currency was low to borrow money there, put it into investments in the United States. Now the Bank of Japan has surprisingly taken rates up. That has sent the yen up as well and has impacted some of those investors who are now selling their positions in the United States to pay back those loans they took in Japan. That's certainly impacting, but also fear about recessionary data, fear about the fact that Warren Buffett, one of the greatest investors of all time, basically sold half his shares in Apple and now holds almost $300 billion worth in cash, probably preparing for something, probably preparing for some buy opportunities. And I certainly don't disagree with him. If you've watched any of my videos in the past couple of months, almost 20% of my portfolio is in cash or bonds. So I'm completely ready for some sort of market corrections because things have gotten a bit overvalued. So somebody made a comment, can you take a look at Apple? Can you take a look at Amazon in one of my other videos? Well, I will do that right now because I think they tell a good story as to why the stock market is where it is and why it's maybe taking a bit of a step back right now. Apple down about 8%, still trading at 200 bucks. So it's important to kind of keep in mind that yes, the market's crashing, but Apple is basically going to be back to prices not seen since like the early parts of June. So you're 2.5 months back. You could have bought Apple at these prices. It's not suddenly such an amazing deal. If you look at Amazon, down about 12%. Their earnings were out a couple days ago, both for Apple and Amazon. Apple earnings were actually pretty good, up 5%. Services growing at a decent clip. Amazon earnings were decent, but a bit lower than expected. But again, you look at Amazon, you're essentially back to prices not seen since January. And yes, that's a couple of months away, but 1 year back, the stock was trading, where it is now. If you look back to the early parts of 2023, the stock was trading in the 90s and 80s. So this has been a market where things have kind of jetted up, and it's not a surprise that people are taking a little bit of their profit away just in case something happens. There's a new election ahead. There's some data around employment that says that inflation is easing, but employment is falling back a little bit, maybe sign of a recession. There's some data that points that we may already be in a recession. Again, nobody really knows this stuff until you look back a couple months uh, after it happens, but at the end of the day, there's certainly some worries. So why is Warren Buffett selling Apple? Well, just look at the valuation. And this is why I sold Apple a couple of months ago when it was in the 190s. It's still the biggest position by far in my portfolio. It still makes up like 30% of my individual stocks, but it was making up 35% plus of my individual stocks. And I looked at the valuation. I looked at a company that, if you look at their earnings growth, their revenue growth is basically flat in the last 2 years and is now trading at a valuation that hasn't been seen for quite some time, forever really. This is the highest it's been priced, well before the drop, trading at a 30x multiple. This is a stock that I was buying when it was trading at a 10 to 15x multiple, and it was still Apple. It was still the same company. It's just that people suddenly reevaluated some of these companies and said, well, this is Apple, this is a marquee name. Bonds are going to be trading at 5% forever, so maybe we should trade up Apple because of AI, because of their new phone upgrades that are going to include AI, and that's certainly going to drive some earnings growth and revenue growth. But is it really going to change the face of the company and make it worth a 30x multiple that it's been worth at for the last couple of years? I think when Warren Buffett looks at something like this, he looks at the valuation. He looks at a company that's suddenly growing at negative 2% in 2023, 1.5% in 24, expected to grow in the mid-single digits for the next couple of years. I think that's optimistic, and looks at it trading at a 3% free cash flow yield against a risk-free rate of 5% right now, and probably thinks, well, it's going to take me a while with my Apple investment to get back to a 5% risk-free rate that I could lock in right now for at least the next couple of years. Maybe I should take some money off the table. He's not selling all of his Apple. He's selling half, just like I didn't sell all of my Apple. I just sold a bit because I still think this is a great company. I think there's plenty of upside. I think this is a safe company, as safe as it gets in terms of investments, and that's why it's trading where it is. But it's trading at a premium valuation. And when you see risks ahead, maybe it's time to take some money off the table. Because if you look at valuations, and disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. It's kind of expensive, right? A 3% free cash flow yield. When I bought Apple stock years and years ago, it was a 10% free cash flow yield. It's probably a better company now than it was back then, given their services growth and things of that nature. But is it a 3 times better company now than it was back then? Or has the market just gotten overvalued across the board? So stocks like Apple, stocks like Amazon, stocks like anything is suddenly being valued at a free cash flow yield that's 3% or lower across the board, no matter its growth. So when you look at Apple, I'm kind of assuming 2% growth next year, maybe 5% growth the year after, as some of their AI phones come into play. I don't think this is going to change the game. I don't think this is going to suddenly make everybody upgrade. It's certainly going to be a boost to revenue and potentially more in 25. But again, that revenue will come down in 26 to kind of normalize across the board. So again, I'll leave these spreadsheets in the description down below. Hit file, make a copy if you want to play around with them. But this is just to illustrate what a look that Warren Buffett is doing to value a company like Apple. So again, slowing growth, margins that are solid, maybe improving up to 29.25. They're basically putting most of their money into buybacks, 60% of their money going into buybacks, buying back a huge portion of the company. And if the price drops, that actually benefits investors in the long run because they'll buy it at a lower price as long as you're holding for decades and decades and don't plan to sell it anytime soon. And then you kind of look at valuation. Well, what's the right valuation for a company like Apple? Historically, in the last couple of years, it's basically traded at a 3% free cash flow yield. If I plop that in based on these assumptions, a standard 3% free cash flow yield and a 10% target return, I get a fair value of about $195. And maybe Warren Buffett looks at it that way, but maybe he also looks at it, well, what if a recession happens? What if the market kind of comes down in terms of its valuation? It goes down to a 4% free cash flow yield. And that's not unheard of for a company like Apple, a company that's basically growing in the single digits. Again, it's Apple, so maybe you disagree, but at the end of the day, it's growing in the single digits. Gets you to a fair value with a 10% target return of about $150. So that's the risk on, risk off analysis he's doing. It's like, well, what's the upside here? The upside here is that some of these AI phones are amazing and people buy them, and suddenly revenue grows at 15% next year and margins improve to 30%, and it stays at a 3% free cash flow yield and the fair value is where it is today. Or that doesn't happen and the growth is mediocre and the market reassesses the valuation of Apple, takes it to a 4% free cash flow yield, and suddenly the fair value is $150. So the upside from here doesn't seem all that amazing. You can certainly play around with the numbers. Obviously, the estimates here are a lot higher than the estimates I'm putting in here. The estimates come up with a final revenue of $544 billion by 2028. I have it $100 billion less, so maybe I'm conservative, and my margins are more conservative as well. So you're a $50 billion difference in free cash flow. So again, I may be very conservative here, but this is somebody who owns a lot of Apple, so I'm just trying to see the downside and seeing where it may go. And this is kind of one of the reasons that I sold off a portion of my Apple holdings, because I own so much of it via index funds. I own so much of it via individual investment holdings. So it's like, well, I could probably put that money elsewhere. For now, I'm basically just keeping it in cash and hope for other values to arise. And maybe that'll happen. It seems like it's starting to happen right now because there's certainly a great company here. It's just a question as to whether or not it's valued fairly by the market. And obviously somebody like Warren Buffett feels like maybe it's gotten stretched a little bit. And I don't disagree with him. Play around with this yourself and see where you feel like it goes from here. But certainly the little drop it's experiencing today, to send it back to June prices, isn't unprecedented. Then we'll look at Amazon. And this is kind of a good comparison because Amazon just had their earnings. Amazon is a company that's also amazing, also a company I own, probably my fourth largest position. I would like to build that out. A couple of things that are the inverse of what Apple does. Apple buys back a lot of shares. Amazon hasn't really. They issue a lot of stock-based compensation, $24 billion in 23. So you're being diluted as a shareholder. One thing to keep in mind. They're growing. They're still growing pretty quickly. They have a cloud business that's growing really well, actually accelerated in the last quarter, which is impressive. That's improving margins. But some of their other businesses, the stores, not super high margin. The Amazon.coms, especially internationally, not super high margin, maybe slowing growth a little bit. Then they have the advertising business, which is also a fantastic business. Again, amazing company, love it. But from a valuation perspective, you're being diluted. So I have a negative buyback here. And then I'm looking at the revenue growth here, kind of in line with the market, maybe assuming slightly slower growth. Again, I think some of this AI stuff, probably not as amazing as everybody makes it seem. pretty good in terms of improving business, improving efficiency. I think it's going to improve margins. But again, it's not going to change the world in the next 2 to 3 years. 20 years from now, sure, but I think we're a long way away from there. So a lot of these companies are investing. It's going to be beneficial to them eventually, but I don't think we're going to see it that soon in terms of how that's generating revenue. You know, all these generative AI stuff, is it going to generate revenue for Google, Amazon, et cetera, in the next year or two? Probably not anything material anytime soon. Then as margins go, I kind of tap out at 12%. So again, more conservative than the estimates here, but I'm just giving you kind of a look as to how this compares against Apple. So you've got a company that's growing at 11%, that's improving margins, obviously worse margins than Apple, but you can essentially get at about a 3.5% free cash flow yield at the prices before the drop this morning. So better value than Apple for a company that's growing faster. If I just use the same thing where even though it's growing faster, I give it a 4% multiple at a 10% target return, I get a fair value of about 152 bucks and expect a return of about 7.8%. So when I look at the two, I kind of get why Apple would be selling off, why Warren Buffett would be selling off Apple. Then I look at Amazon, it looks more interesting to me right now, at least. It looks like more of a value because if it drops today into that $152 range, which it seems like it will, it's getting to a point where based on these assumptions, and again, these are assumptions that could change if there's a recession, etc., the valuation gets interesting. And that doesn't mean I'm going to suddenly buy put all of my money into Apple. It just means into Amazon. Sorry, it just means that Amazon certainly looks more interesting right now than Apple, and I understand why Warren Buffett might be selling Apple and just holding cash for now because there's a lot of stuff going on. If there is a recession ahead, a lot of these stocks will continue dropping. Remember, Amazon was trading at $80 to $90 a year and a half ago. Apple was trading probably in the 130s a year and a half ago. Not much has changed with the business in that time. It's just that valuations have expanded. Obviously, Amazon has gotten more cost conscious. I think Amazon has changed more than Apple in terms of improving their margins. So maybe Amazon is now a better business than it was a year and a half ago. That's why the multiple has expanded so much. But with Apple, has anything really changed? You know, they released a Vision Pro, which was kind of a dud. They have their AI thing coming up, which is maybe going to improve their future phone cycle. But you have to have some pretty significant assumptions here to make the valuations make sense, assuming that the multiple stays where it is, which is at 3%, which is a historically high multiple for a company growing like Apple. And that's just the reality of it. So when I look at these, Apple for me right now is probably a hold. If it does drop into the 150s, would I buy more? Sure, maybe, because it's such a large position for me already. Not so sure. It's potential that there's some potential that I actually sell some more Apple just because when I look at this now, I'm like, maybe the downside is bigger than the upside right now. And that doesn't mean that I'm going to sell all my Apple, but if I reduce my position from 30% of my individual stocks to 25% and put it into other positions that are now suddenly more interesting, more appealing, wouldn't be the worst idea in the world. Then as I look at Amazon, margins are improving, potentially some pressure on growth in the future. So I'm kind of being more conservative here. But even with this conservatism, even at a 4% free cash flow yield, which is about the same I'm giving Apple, a much slower growing company, it's still getting to a price point that's not too far away from where it's trading at today. So Amazon looking interesting, Apple looking a bit overvalued to me. Own both, plan to hold both forever, because when I think about what happens in the next year, it doesn't really matter to me. What matters to me is what happens 10 years from now. And 10 years from now, I think Apple is going to be a stronger company than it is today with a lot more free cash flow. And I think Amazon is going to be a much stronger company than it is today with a lot more free cash flow. So as long as the valuation is fair, I'll buy both of those and continue adding them and holding them for the long term. And those are just two big names that I own. I own a variety of other stocks. And in the next weeks and months ahead, if the stock market keeps moving down, that's only a good thing for me because I have a bunch of cash. I want to deploy it, and better valuations ahead means good things for long-term investors. Even if you bought Amazon at 200, I think 10 years from now, Amazon is going to be way higher than 200. So I wouldn't be worried about that as an investor. So that's my thoughts on the downside with these two stocks, the upside with these two stocks. Let me know if you disagree. Let me know what you think about what's happening in the market. Leave a comment down below. Thanks for watching. Bye.